Hi, uh, my name is Rohan, and I'm presenting my corporate valuation application for Project One for our AI in Finance course. In the world of finance, we often focus on price, but as Benjamin Graham famously said, price is what you pay, and value is what you get. The problem this app specifically solves is the black box nature of valuation. Most retail investors see a price target for a company like MasterCard and take it at face value. This tool pulls real time financial data for any ticker and, more importantly, allows us to stress test and the assumptions that drive that value, like interest rates and growth expectations, so we can find a true margin of safety. As you can see here, I could probably put in any stock ticker. For example, let's say if we want to see Apple's, and we can find all their current assumptions, the financial projections over the next 5 years, the valuation results, and a sensitivity analysis. We could also get the enterprise value and see the value along a trend. We can see a couple of assumptions here as well, like its growth rate, operating margin, and we could toggle them according to our wish. We could also see our weighted average cost of capital or the discount rate here. You could toggle that to find out the new analysis for the company itself. Let's see, for example, let me choose MasterCard, right? The stock ticker is MA. As I enter the ticker, the app is hitting the API to retrieve the latest trailing 12-month data. You can see the green confirmation data fetched for MasterCard Incorporated. My app has basically pulled a current revenue of approximately $32.1 billion, as you can see right here, with a high performing operating margin of nearly 59.7%. Looking at the Section 2 results, the model currently outputs as an enterprise value of 480 billion. When we look at the per share value, the model is currently spitting out at 350 for a WICC of 8, and compared to the current stock price of nearly $515, the app tells us that the stock must be priced at a premium. But as any analyst knows, the base case is just the starting point. We need to look at the why and behind these numbers. Let's look at the assumptions. So this is the most critical part of any evaluation. My rubric requires a breakdown of the weighted cost of capital and growth. So let's dive in. So how I calculate weighted cost, average cost of capital. I didn't just pick this number. I used the CAPM model. MasterCard has a beta of roughly 0.96, meaning it's slightly less volatile than the overall market. I used a risk-free rate of 4.2% based on the current 10-year treasuries rate and an equity risk premium of 4.5%. When you weight this against MasterCard's relatively low cost of debt, we arrive at an 8.5 WACC. This is a reasonable discount rate because it reflects the low risk of MasterCard's dominant duopoly position, along with Visa, the duopoly here. Why a 14% growth rate, you might ask? That would be here. So, MasterCard's historical 5 year average revenue growth is about 16%. However, for the next 5 years, I'm being slightly more conservative at 14%. But why? While the shift from cash to digital is a massive tailwind, we are seeing increasing regulatory scrutiny over interchange fees in the US and Europe, which could provide a slight drag on top line expansion. When we talk about terminal value, I'm using the perpetuity growth method. I've set this to a 2% because a company cannot grow faster than the overall economy forever. If I set this higher, I'd be assuming MasterCard eventually becomes larger than the global economy, which is a common error in aggressive models like these. So, when we talk about adjusting assumptions in this scenario, let us move the WACC. Let us move it to a point 7.5%, or roughly 8, let's say. That would be better there. And then we can see the change right here. Now let's move it to 16%. Now let's test a real what if scenario. Real analysts need to know, what if interest rates drop? If the Fed cuts rates and our WACC drops by 7.5%, what's the per share value, right? It really drops quite a bit. Sorry, if I say the WACC goes down, the per share value would go up significantly, as you can see right here. But this would basically show that a lower discount rate makes those future cash flows flow more valuable today, right? Conversely, if we assume MasterCard can maintain its historical 16% growth instead of 14%, for example, let me do that right here, we see the equity value climb, right? By adjusting these sliders, the user can see exactly how much of the current stock price is priced for perfection versus actual fundamental value. Finally, let's look at the sensitivity analysis. This table is the heart of an investment decision. It shows the per share value across the matrix of different WACC and terminal growth outcomes. In the top right corner, you'll see a low WACC and a high growth scenario. MasterCard looks like a steal. In the bottom left corner, however, you can see a high WACC and a low growth scenario, and it looks quite dangerous. By looking at this value range, I can conclude that at a market price of $515, MasterCard is fairly valued only if you believe that they can sustain double digit growth. If you're a conservative investor who expects a recession or a higher WACC, this tool shows you might want to wait for a dip closer to the $450 range. So this app transforms a static spreadsheet into a dynamic decision making tool. You could try this out with any stock ticker you choose. You know, like I just showed, I put in Apple earlier, and we could see it get the data for Apple instead. The same way we could change the growth rate, change the WACC accordingly. Thank you for watching.